Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Peter van der Schwan, and in each episode I share my thoughts with you on a topic or a recent development in the field of South African tax. And I try to do it in the time that you might have available if you need to take a bit of a break from work. Our topic for today is Section 42 of the Income Tax Act. Now, it seems to be a provision that a lot of advisors are quite fond of, but I do think that many people are not fully aware of the hidden cost of this provision. So if you compare it to, for example, Section 45, where the legislation clearly states that if you utilize the rollover provided by that, you need to stay part of the same group of companies for the next 6 years. The cost of Section 42 is not as obvious as Section 45, for example. So our focus for today is to highlight what this potential cost of doing a Section 42 transaction is. If I can perhaps start by, before we go to what the cost is, let's perhaps recap what exactly is Section 42 of the Income Tax Act. Now, it's a corporate rule, and these corporate rules are really a set of rules that enable persons to do reorganization transactions in a way that is tax neutral if the person doesn't really disinvest from the asset. So if you are merely reorganizing your affairs, then to be more efficient, then tax shouldn't be an obstacle. And that's really the purpose of sections 41 to 47, where we find these corporate rules, is to allow you to do these tax neutral transfers of assets. If we then look at Section 42 specifically, it deals with asset for share transactions. Now, an asset for share transaction, there's a definition in Section 42 for what this is. The definition talks about a person. It doesn't specify who the person must be. So any person must dispose of an asset with a gain included in it. So in other words, the market value of the asset must exceed its tax cost, or at least be equal to it. And there are some assets that do not qualify for Section 42. So those are personal goodwill and restraints of trade. This asset must be transferred by the person to a company that's a resident, and as consideration, the company must issue equity shares. So in other words, the person transfers the asset, the company now acquires the asset, and the person acquires an equity share interest in the company. Section 42 then goes on to say that the person must hold a qualifying interest in the company. So it's got some further requirements as to what the person's continued economic interest in this asset should be. Now, I think that's in some broad terms. There are obviously some more nuances to this definition the deeper you start going into the definition, but these are some of the critical aspects of it. Now, where do we often see Section 42 being used? In my experience, if a person wants to move assets into a company, so moving assets from a person's own name or from one company into another company, that's one of the places where Section 42 often features. And then it's also quite prevalent where holding company structures are established. So in other words, a person holds shares in a company, and the idea is to then introduce a holding company between the person and the investee in which the person holds the shares. And Section 42 works quite well to introduce that holding company. So let's then move over to the relief that's available under Section 42. So firstly, let's start with the transferor. In other words, the person who transfers the assets to the company. The transferor will be deemed to have disposed of that asset for an amount equal to its tax cost. So let's take a simple example just to make it a bit more practical. So I've got a building that I own. I paid the R1,000,000 for the building. That's its base cost. Let's assume I didn't claim any allowances for now. And the building has now got a value of 10 million rand. So if I were to just dispose of the building without any relief, my capital gain on the sale of that building would be 9 million rand. The effect of the relief, the deeming the asset to be disposed of for an amount equal to its base cost, is that I've got the base cost and the proceeds that equal each other. So therefore, I've got no capital gain. That's where the relief firstly comes in for the transferor. The second aspect where the relief also comes in for the transferor is that if the transferor claimed some allowances on the asset, these allowances will not be, the transferor doesn't have to recoup these allowances. Whatever the transferor claimed will roll over to the transferee, and the transferee, the company that now acquires this asset, could possibly be required to recoup these allowances in future. Moving over to the company, the company that acquires the asset, this company really acquires the asset with all the same tax characteristics as the transferor. So the same date of acquisition, the same expenditure to acquire the asset, and if the transferor claimed allowances on the asset, the company can only claim the remaining allowances. And if the company sells the asset, the recoupments that could possibly arise would be based on the allowances that the company itself claimed, but also the allowances that the transferor previously claimed. So all these tax characteristics roll over to the company. So let's take an example to make it a bit more practical again. I've got a building with a cost of 1.5 million rand. I've claimed allowances of 500,000 rand on this building. So that gives us, if you look at the technical definition of base cost, a base cost of 1 million rand. So it's the 1.5 million that I've paid, less the 500,000 that I've deducted for income tax purposes. And the company will now then be deemed, if I sell this building to the company using Section 42, the company can only claim the remaining allowances of the million that I haven't claimed yet. And if the company sells the building and let's assume it's claimed the full 1 million rand that was available, it would be required to recoup allowances, the 500,000 that I've claimed before as a transferor, plus the 1 million that the company claimed as that was available to it after it acquired the asset. The last implication of Section 42, and this is really where this, let's call it the additional cost or the hidden cost comes in. The transferor will be deemed to have acquired the shares in the company for an amount equal to the base cost of the asset. And this same amount will be added to the contributed tax capital of the company. So let me explain the hidden cost. And let's go back to my example of an asset that's worth 10 million rand with a 1 million rand tax cost or a base cost. Now, assuming that there's no value mismatch when I do the asset for share transaction, and I think that's a topic for a different day to talk about value mismatches. But assuming that that's not the case, if I've contributed my asset that's worth 10 million rand into the company, assuming that there was nothing else in the company before, in principle, the shares in that company should also be worth 10 million rand now. So I've utilized the rollover relief under Section 42. So this gain of 9 million rand didn't arise in my own hands. So under the rules I just explained, I've got shares with a value of 10 million rand. I'm deemed to have acquired the shares for an amount equal to the base cost of the property I sold, the 1 million rand. So in the shares that I've got in this company, there's a 9 million rand gain that will be taxed if I sell the shares in the company. What we need to then remember is that within this company, there's still an underlying property that still has got its 10 million rand value. the company is deemed to have acquired it for the same expenditure that I've incurred, so in other words, the same base cost. So on this property, there is still also an unrealized tax gain of 9 million rand if the property is sold. So what Section 42, the mechanisms of relief in Section 42 really do is that every time that you do a Section 42 transaction, this gain is duplicated. So the gain remains in the asset that the company acquired, that was transferred to the company, and the gain also now exists in the shareholding in the company. And the more times you do these transactions, so I've seen a lot of advisors who sort of set up structures with multiple layers. At every layer, this gain duplication happens. So in closing, I'm not saying that Section 42 is not a useful provision. I think there's a lot of instances where it's got a place, and it is something that definitely has a purpose in corporate planning. But I think that you need to be fully aware of the effect of using it before you enter into these transactions. So it might be something that once you understand the duplication, it is something that can be in the back of your mind, that you just make sure that whatever transaction you do in future, you try to do it in a way that you don't, that this duplication of gains don't come to realization that you pay tax on the gain twice. I think that is all for this episode. Thank you for listening. And if you enjoyed the podcast, please subscribe on your podcast platform and tell all your colleagues and friends about it. If you've got any questions that you would like to ask me or that you would like me to consider in a future episode, you are more than welcome to email it to me. My email address is in the show notes. And as always, nothing in this podcast should be construed as tax advice or even a substitute for fact-specific tax advice. Until next time, goodbye.